Here are 3 things you can do in today's housing market. Hey guys, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. If you're thinking of buying or selling a home, give us a call, a text, or an email. We absolutely love helping people out moving on to their next chapter. If you've been looking for a home in the Eastbay or in the Bay Area in general for the last couple of years, you know how tough it's been. If you follow the channel, you've heard me say this, that now is a great opportunity to buy a house. But it's still not easy. It's clear the 2022 housing market has been defined by rising mortgage rates. With rates on the rise, it's also become more costly to purchase a home. According to the National Association of Realtors, or NAR, compared to 1 year ago, the monthly mortgage payment rose to $1,944 from $1,265, an increase of 53.7%. That is on a national level and based on the national median home price of around $400,000. We all know that that doesn't get you anything here in the Bay Area, so that figure is more like double or triple for us here. If you're thinking of buying a home or have been trying to recently, that's a big increase in monthly mortgage payment, and it may be causing you to press pause on your plans. This jump is making homes less affordable, especially compared to the last 2 years when mortgage rates were at historic lows. The good news is you can navigate today's housing market in this rising rate environment with a few simple tips. Here are 3 things you may want to consider to help make your home ownership goals a reality. Number 1, expand your search area and criteria. If you've been looking for a home in the city center or a specific area that's starting to feel out of your price range, you may want to try looking a little further out in a location that could be more affordable. Expanding your search area location or reprioritizing the items on your wish list can open up opportunities you haven't considered, and that could help you afford more of what you need and want in a home. As CNET notes, area growth is likely to keep pace with the market, which means that the outskirts of town might be hopping within 5 years. Considering stepping out of your ideal location by searching in nearby cities, you may find better prices and more square footage. Here in the Bay Area, if you were looking, say, in the peninsula, it could mean looking across the bridge to the East Bay, or if you're already looking in the East Bay, that could also mean looking more inland. Criteria-wise, you might make a couple of changes to your wants and needs. Once you have a home, you will find that not everything that you wanted in a house is something that you needed. The important part is getting into a home. Number 2, explore alternative financing options. This is a big one, especially in this increasing mortgage environment. Working with a trusted lender to learn about different loan types and options is essential. According to NerdWallet, a variety of mortgages are available with varying down payment and eligibility requirements. Experts know how to point you in the right direction when it comes to exploring ways to find the best home loan for your situation. With rising mortgage rates making it more costly to finance a home today, there may be an ideal option out there your loan officer can introduce you to. This could make a home purchase more affordable and within your financial reach over the life of your loan. You do not always have to get a 30-year fixed rate loan. You can get adjustable rate mortgages, or you can buy down your rate to make it lower. We have a saying in real estate, marry the house and date the rate. You can always change your mortgage. Not so easy with a house. And with mortgage rates projected to stabilize next year, it could work out better. The 3rd tip, look for grants, gift funds, and down payment assistance. There are many options available when it comes to securing the funding you need to purchase a home. One valuable resource to explore is downpaymentresource.com. Although I would say it's much better to talk to your lender. They know better what is available locally. Searching for a specific down payment assistance options available in your local community could be a game changer when it comes to taking your first step towards home ownership. As NAR indicates, many local governments and nonprofit organizations offer down payment assistance, grants, and loans targeted to area borrowers and often with specific borrower requirements. Plus, there are programs and specific benefits for individuals working in certain professions or with unique statuses, including teachers, doctors, nurses, and veterans. Ultimately, that means there are many federal, state, and local programs available for you to explore. The best way to do is to connect with a local real estate professional and your lender to learn more about what's available in your area. And I also would like to add this. If you're using these low down payment or down payment assistance loans, or loans like CalHAFA, FHA, or VA, this is your opportunity with competition being very low. The last couple of years, it was downright tough to get an offer accepted if you had these types of loans because of extreme competition. And if competition comes back, you might find your offers not as competitive again. So take advantage now. But some of you might be saying or asking, but Mac, isn't there a housing bubble brewing? Not exactly. It's more like a slowdown. The talk of a housing bubble in the coming year seems to be at a fever pitch as rising mortgage rates continue to slow down an overheated real estate market. Over the past 2 years, home prices have appreciated at an unsustainable pace, causing many to ask, are things just slowing down or is a crash coming? To answer this question, there are two things we want to understand. The first is the reality of the shift in today's housing market. And the second is what experts are saying about home prices in the coming year. The reality of a shift in today's housing market. The reality is we're seeing an inflection point in housing supply and demand. According to Realtor.com, active listings have increased more than 26% over the last year, while showings from the latest showing time showing index have decreased almost 17% from last year. This is an inflection point for housing because over the past 2 years, we've seen a massive amount of demand and not enough homes available for sale for the number of people that wanted to buy. That caused the market frenzy. Today, supply and demand look very different and the market is slowing down from the pace we've seen. This offers proof of the sudden slowdown so many people are feeling. Right now, most experts are forecasting home price appreciation 2023, but at a much slower pace than the last 2 years. Here's the average of the 6 forecasters for national home prices. 2.5% in the coming year. Only one of the 6 is calling for home price depreciation. Which begs the question, what do they know or what data do they have that is causing them to come up with a different forecast? When we look at this shift taking place along with what experts are saying, we can conclude the national real estate market is slowing down, but it's not a bubble getting ready to burst. This isn't to say that there are overheated markets that won't experience home price depreciation. But there isn't a case to be made for a national housing bubble. And that is also true here in the Bay Area. I've always said this, the markets that get affected faster are usually the ones that are an hour or more away from city centers like San Francisco, San Jose, Oakland. Before I go, let me just share with you these 3 graphs that further proves why this is not a housing bubble. The first one is supply. I've talked about this several times already on this channel. Even with the current slowdown, the underlying issue of supply is still there. Demand has not gone away, it's just on pause. There's still a shortage of homes and not a surplus. The supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued price appreciation. For historical context, there were too many homes for sale during the housing crisis, many of which were short sales and foreclosures, and that caused prices to tumble. Today, supply is growing, but there's still a shortage of inventory available. The graph here uses data from the National Association of Realtors to show how this time compares to the crash. Today, unsold inventory sits just around 3 months supply at the current sales pace. In the Bay Area, we are still below 2 months supply at the current sales pace. One of the reasons inventory is still low is because of sustained underbuilding. When you couple that with ongoing buyer demand as millennials age into their peak home buying years, it continues to put upward pressure on home prices. That limited supply compared to buyer demand is why experts forecast home prices won't fall this time. Here's the second thing why this is not a bubble. That is how strong buyers are now financially compared to the mortgage meltdown. Mortgage standards were much more relaxed during the crash, or to be candid, almost non-existent. During the lead up to the housing crisis, it was much easier to get a home loan than it is today. The graph here showcases data on Mortgage Credit Availability Index from the Mortgage Bankers Association. The higher the number, the easier it is to get a mortgage. Today, we are way below those numbers. Running up to 2006, banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home loan or refinance their current home. Back then, lending institutions took much greater risk in both the person and mortgage products offered. That led to mass defaults, foreclosures, and falling prices. Today, things are different and purchasers face much higher standards from mortgage companies. Mark Fleming, chief economist at First American, says this: credit standards tightened in recent months due to increasing economic uncertainty and monetary policy tightening. Stricter standards like there are today help prevent a risk of rash foreclosures like there was the last time. And finally, the dreaded F word, foreclosure. The foreclosure volume is nothing like it was during the crash. And this is true whether we are looking at the numbers prior to the pandemic and during the pandemic when there was a moratorium on foreclosures. The most obvious difference is the number of homeowners that were facing foreclosure after the housing bubble burst. Foreclosure activity has been on the way down since the crash because why? I go back to my number 2 reason. Buyers today are more qualified and less likely to default on their loans. And in addition, homeowners today are equity rich, not tapped out. In the run-up to the housing bubble, some homeowners were using their homes as personal ATMs. Many immediately withdrew their equity once it built up. When home values began to fall, some homeowners found themselves in negative equity situation where the amount they owed on their mortgage was greater than the value of their home. Some of those households decided to walk away from their homes, and that led to a wave of distressed property listings, foreclosures, and short sales, which sold at considerable discounts that lowered the value of other homes in the area. Today, prices have risen nicely over the last few years, and that's given homeowners an equity boost. According to Black Knight, in total, mortgage holders gained $2.8 trillion in tappable equity over the past 12 months, a 34% increase that equates to more than $207,000 in equity available per borrower. With the average home equity now standing at $207,000, homeowners are in a completely different position this time. Look, here's the bottom line. If you've been searching for a home and have found yourself stepping out of the process because you're worried about rising costs or talk of a bubble, this is actually a great opportunity to buy a house. If you need help buying or selling, give us a call, a text, or an email. We'll help you through the process and get you in the home of your dreams. Stop paying for your landlord's mortgage. By the way, speaking of landlords, it's also a great time to buy an investment property. Rents are going up. If you don't believe me, just Google corporations buying houses. Institutions are buying up houses because it gives them high returns on rents plus appreciation on their investment. Hey, thanks for watching. Please like this video, share this video, and subscribe if you want to be on top of real estate news and not hyped up real estate news. Have a great day.